Whenever I see a big rush of money into ETFs, like we did in XIV, which was the short volatility funds, like we did in USO, and I'm picking those for a particular reason, the United States Oil Fund, it is typically what I would refer to as a weak-handed player. They're there for the trade. They're there for the quick profit.
There will be times where things are strained. I just don't think the ETF investor, be that retailer or advisor, is as weak-handed as the implication. I think because of the other dynamics I'm mentioning, I think they're going to be stronger holders than people think. I also give some reliance to some of the size of these issuers, the Fidelities and BlackRocks of the world. There is such a motivation for them not to fuck this up. Like this would be a massive PR issue.
MicroStrategist and founder and president at Bianco Research, Jim Bianco, has some concerns about the largely unprecedented performance of the spot Bitcoin ETFs. About 2 weeks ago, in a post on X, Jim made a comment about volatility in ETFs, comparing the Bitcoin ETFs to the VIX and the United States Oil Fund ETF. His post reads, "Short volatility ETFs were created to sell vol. They blew up the VIX in February 2018 when it spiked from 12 to 50 in 2 days. The ETF USO cornered the front contract crude oil futures open interest. When it rolled to the next month, it distorted crude oil prices that the front contract traded negative $40 in April 2020. These are two examples of ETFs overtaking their case market and ending poorly." Jim brings up the same concerns while discussing with senior Bloomberg ETF analyst Eric Balchunas during a recent interview with Blockworks Macro. According to Jim, the narrative that the spot Bitcoin ETFs are being purchased at such record numbers by wealth managers is false. Instead, he believes the bulk of the purchases are being made by retail investors, who are mostly weak-handed compared to institutional investors. Jim argues that the same thing happened with the USO and the Chinese funds last year, with an initial big rush of money, which propels prices upwards. Then everyone takes profits at the same time and exits at the first signs of trouble. Jim also argues that the investors we see with the spot Bitcoin ETFs are mostly in it for the profit, not wealthy institutional investors who are generally more committed. In response to these concerns, Eric counters that the retail investors Jim describes as weak-handed and ready to bolt at the first signs of trouble can bear much more volatility than Jim gives them credit for, because the ETFs only make a small percentage of their portfolios. Eric further argues that BlackRock, Fidelity, and other issuers of spot Bitcoin ETFs are established names that cannot afford the bad PR that comes with the 90% drawdowns Jim is predicting. We will now bring you clips from the spirited debate as Eric and Jim deliberate on how strong the Bitcoin ETFs have become and what we can expect from them going forward. Please watch, share, and like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Couple things here. First of all, I think what I do agree with, I think the retail buying has been greater than anybody thought. If you look at the number of trades and the size of the trades, clearly there's a lot of retail buying the Bitcoin ETF. I would say that this retail, typically a retail investor who uses ETFs, is not the GameStop ape type. In my opinion, these are usually a little more with it because they know what an ETF is. They know it's cheap. Usually ETFs, generally, you have to find them, right? They're not like really paying much for distribution. So generally ETF investors are a little more savvy than, say, the GameStop. Number two, when you think about Bitcoin, I think, and this is something that I've been prophesizing for about 5-6 years, and it's something that I made a call on around ARK that I nailed. And it was a hard call to make, but I was right. That the more Vanguard and low-cost beta takes over the core of portfolios, right? So you have a base of like serious investor adult assets. The more you look for stuff that's completely different, you have in my opinion, a hot sauce bucket. Now, that could mean a Robinhood account. It could mean trading stocks. It could mean options. It could mean ARK. It could mean thematic ETFs. To me, Bitcoin fits perfectly there. So I see these retail investors, especially given the size of the trades, as putting in like 1% of their portfolio or less. Now, the reason that matters is that my assumption, and I think I'm right, most of these people probably have a base 401k type, where their serious money is. Therefore, they will have more tolerance when there's a sell-off, because this isn't the whole enchilada, right? This is just a portion of the portfolio. And now some people may be like, well, the stock market's selling off too. Let me get rid of my Bitcoin first because I don't want to sell my stock market. Maybe there'll be a little of that. If we have a precedent of ARK, there was clearly everybody's like, wait till the music stops. It's going to be a run, like a bank run. None of that happened. ARK actually took in a little bit of money net over the next year. Now, they've been treading water since. It's not like they're killing it again. But just the fact that they survived an 80% drawdown, I think speaks to the nature of portfolios and how they've changed, and the nature of the tolerance of volatility from somebody who has a 60-40 core. Not everybody is going to be this person. I get it. So I think in a drawdown, let's say it's 20, 30% over a couple months, I think you see certain ETFs are used more by traders like IBIT. So IBIT could have like maybe an institution or some traders who get out quickly, or maybe they short it real quick. So IBIT could see a little more up and down flows, sort of like SPY does. I think FBTC and these other ones will be a little more secure. These to me seem like more long-term money. Fidelity's probably using their advisory network. IBIT is probably going to be like the GLD. And it goes up and down, there's flows in and out. But net, if we take any long net period, it's typically net inflows. But even in 2008, like SPY had like 3 months of outflows, but then 6 months of inflows. It netted out to positive. So I think there will be some outflows here and there, especially on IBIT, again, because it's most liquid. It's going to attract the most traders. But to me, this is all just sort of like normal. I think what I don't think is going to happen is some crazy run on the ETF. And in terms of the design flaws, I think junk bond ETFs gave us a little bit of what something that's illiquid in a liquid wrapper will do. But again, investors were pretty well behaved. In every sell-off, they didn't go crazy selling HYG. Little selling, but not crazy. And so I even look at like SPY in 2008, HYG during 2020. There will be times where things are strained. I just don't think the ETF investor, be that retailer or advisor, is as weak-handed as the implication. I think because of the other dynamics I'm mentioning, I think they're going to be stronger holders than people think.
During the conversation, Eric argues further that most of the investors buying the Bitcoin ETFs, whether they are retail or institutional investors, are mostly putting in a small percentage of their portfolios. Their core positions are still in stocks and bonds. As a result, Eric believes even a 20% drop in Bitcoin's price will not have them running for the hills. Eric also comments on Jim's statement about the outages Coinbase has been experiencing as a result of the unprecedented demand from the ETFs. He admits it could be an issue if demand increases further, but not so much to dissuade investors from investing in the ETFs. Despite his concerns about the ETFs fizzling out tragically in the months ahead, Jim is a strong Bitcoin and crypto advocate. During the conversation, he and Eric also discussed the general atmosphere of the cryptocurrency market and why it appeals so much to younger investors. Here are more clips from the interview.
There's a lot of appeals. I'm going to answer your question a little bit differently, Mike. There's a lot of appeals to crypto. Is it Joe Weisenthal actually was kind of making fun of the crypto community on what's been happening. And I kind of agreed with everything he said. That's why I brought it up, is that we always have these narratives with crypto, right? That it's going to be the world computer. It's going to be the leading edge of Web3. It's going to introduce the metaverse to everybody. It's going to be sound money. It's going to be an alternate financial system. What I fear now is that they've kind of thrown all those aside and they said it's now just number go up. And that's what Weisenthal was saying. Okay, at least you guys have pulled the mask off. You just want number up. That's really what the narrative is right now, as opposed to all of these other ones. But I do think that there's probably a thing about young people that they're always up for something new, something different. And crypto is definitely new and definitely different. There might be some nihilism about the current state of the affairs when they hear about budget deficits and they hear about debt and they hear about, the problems with the current financial system or the problems that we've experienced over the last several years, that they feel like that's not going to be there for when they're our age or my age. And so therefore they want to transition themselves into something different. I guess those would be kind of my guesses as to why they're. Now, I'll just answer finally by saying the reason I'm here is because, or I'm bullish and I love the space and been in the space for 7 years, is that I believe in the alternate financial system. DeFi was the thing that really got me going as a TradFi guy. And I'll be very simple. 2 billion people live in Asia, Latin America, Africa, the Middle East, and they live in regimes that have lousy currencies that constantly get devalued and corrupt financial systems. And if you want to bring to them a digital currency that has a hard cap that no one can, really monkey with, and bring to them an alternative way to own it, trade it, transact in it, and that would be some version of DeFi, whether it's going to be on the blockchain, Bitcoin blockchain, the Ethereum blockchain, or whatever, Tron or Solana, whichever one you want, or some other one. I'm all in on that. And so that's where I definitely think that the space should go. My concern is there's a lot of people that are building and developing on that this shiny new toy is going to take attention away from it. Why should I give money to a VC? Why should I give money to a new protocol? Why don't I just put it in IBIT and watch it just go up 10% a day? It's easier. It's simpler.
There's one other point I wanted to make. About why you buy it. Someone, this guy, he was the guy who got viral because he was like arguing with his daughter back and forth. Ben Hart, I think his name is. He basically said, Bitcoin is the Second Amendment of money. And that it kind of clicked something for me. I understand what he's saying. Like Jim said, the government cannot monkey around with it. And I think people even feel like that way about the dollar, let alone a emerging market currency. And I think that's a powerful concept. I think most people can understand that. Like my mom can understand that. She understands the Fed prints money. She understands that like $35 trillion in debt is probably not good. These are things that I think the trollers miss. People have genuine worry about how the government has created so much debt. And, okay, it's not going to be a problem today because America is such a thriving economy. But at some point, is there going to be some kind of a real issue with this? And will Bitcoin really hold up well? I get it. I mean, and if you have something that stores that value, then again, just like a gun, the government cannot take that from you. You have a protection. That's the whole Second Amendment's about, is to protect yourself from the government.
Do you share Jim's concerns about the spot Bitcoin ETFs taking the escalator up and the elevator down? Or Eric's optimism that both the issuers and the investors are strong enough to withstand whatever the market throws at them? In a recent post on X, Jim again argues that the buyers are weak-handed speculative degens looking to make quick money, and they could rush out just as quickly as they've rushed in if things go sideways, which would be disastrous for Bitcoin prices, at least in the short term. A section of the article reads, "If I'm right, as the old TradFi saying goes, take the escalator up and the elevator down. This rush of this weak-handed speculative money in could rush out, turning correction into a rout. And this tidal wave of outflows, or coins, must find a buyer at any price immediately. This could expose a design flaw in these spot Bitcoin ETFs, no in-kind transfers. If so, it risks damaging the promise of getting that long-term adoption money, which will take years now and much longer if the market starts looking like an out-of-control casino." This is another case of whether the spot Bitcoin ETFs are bad or good for the underlying cryptocurrency. Both men, experts in their respective fields, have presented solid arguments. What are your thoughts on the video? Please drop your comments and observations in the comments section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.